Hey everybody, welcome to the webinar tonight. Happy to have Ches Hagen with AP Capital on the line. Ches, how you doing tonight?
I'm doing great, Peter. Thanks for having me.
Fantastic. Well, you know what? We've got a record number of people joining us tonight because I think this is a hot topic. And I'm curious if it's just coincidence or not, but we're going to be talking about investing in mortgages. One of the big topics I've always talked about for ages now is the whole concept of why Canadians should invest like a pension fund. I wrote an article on that, and I'm going to attach that at the end. So anybody attending this, or if you're listening to this on a recording, ask me for a copy of that article. Whole concept is that I think everybody should invest like a pension fund, and that means you invest in stocks and bonds, sure, but pension funds also invest directly into real estate and into private equity, things like mortgage funds, and we refer to that as non-correlating assets. The reason I think that's interesting today in particular, Jess, we just had the U.S. midterm elections yesterday, and somebody might say, well, what's that got to do with mortgages and investing? Well, politics has an impact on the markets, and the markets were pricing in a correction because they anticipated the Democrats taking control of the House, which is what happened. I noticed the markets in the States did not go down today. I think they already adjusted for that reality. But the point I'm making is it's amazing how your pension or your RSPs or your mutual funds can be impacted in a very volatile way just because of something Donald Trump does or U.S. politics. So I know, Ches, you don't like to get into that side of it, but it does create a perfect segue for why it's important for the people on this call, as much today as any time, to be looking at non-correlating assets.
It certainly does. And, you know, I think if anyone has been invested in the public markets in the month of October, they want to quickly forget that month happened and hope that the month of November rebounds and maybe takes them back into the positive, because it was a pretty tough month. When you're in the business that like we are, that's outside of the public markets, October was a strong month, not affected in our world by what happened in the public side. So we'll get into that a little bit more today, but certainly interesting times.
Yeah, absolutely. So you made the point, not affected on your side. So when something happens in U.S. politics, the stock markets can go up, down, or sideways. We refer to that as volatility. But one of the things you're going to be talking about is what is a MIC, investing in mortgages. We're going to talk about what a MIC is, why you might want to consider investing in it. Is that a safe investment? And we're going to talk about the fact that not all MICs are created equal. A MIC is an investment vehicle that allows you to invest in mortgages. Just you're going to talk about that, but more importantly, it doesn't go up or down like the stock market. So without further ado, Ches, I'm going to pass this over to you and help educate us a little bit about what investing in Canadian mortgages is and what AP Capital does.
Great. Well, thank you very much, Peter. Thanks for having me. Again, my name is Ches Hagen. I'm one of the managing directors and founding partners here at AP Capital. We started this business back in 2007, so we've been at this a little over 11 years. I'll talk a little bit more of our history and performance over those last decade as we go through. As you mentioned, today we're going to look at an investment option for Canadians that has to do with investing in mortgages, very specifically in the mortgage business. So I'll get into that a little bit more. Naturally, in a presentation like this, we include a disclaimer, and this disclaimer just speaks to this presentation being for an introductory information only. To invest in a company like ours, an offering memorandum is provided to each investor that outlines many of the elements that will not be discussed today in this presentation. There's many elements that people should consider, considering all of the risks that come in an investment like ours or any investment. They should be thinking about suitability. They should be thinking of concentration of their investment, and all of those things should be discussed with a professional like Peter Kinch, our host today. So with that, I'll continue and speak a little bit more as to what it is that we do at AP Capital. We run a mortgage investment corporation. Now, a mortgage investment corporation is often shortened when people talk about us as a MIC or an MIC. And MICs have been around for more than 45 years. They started in 1973. They were introduced in Canada by the federal government in a budget, and really giving an alternative in the mortgage industry to the big banks that really owned literally 100% of the mortgage industry back in the 70s. It also allowed Canadians to become investors in a pool of mortgages that was run by a managing entity. So they've been around for a long time. They've been strong in the western provinces. In British Columbia, we have many MICs that have been around for 30 plus years. They've existed in Ontario and many of the provinces. So there's a long life to mortgage investment corporations. Largely, they haven't been available to the retail world, meaning the general consumer, general investor, because so many of them were held closely by friends and family and just a network of contacts by the managing operators. And so I would say that in the last 5 to 10 years, under new capital rules that have been introduced across Canada, they become a little bit more talked about. They're a little more available to the general investor that exists. So let's look a little bit more at them. First of all, I just want to touch on some of the high points that maybe come to people's minds when they think about AP Capital. First one that often people ask is, what are your returns? What has your historical return been? We target in our fund to deliver 7% or better to our investors every year. That's net of fees. That is delivered to them as an investor in the form of a yield. And we deliver that 7% monthly, either in cash or in share reinvestment, what we call our DRIP program. And then any amount above 7% that our audited returns result in is distributed in a 13th distribution. If you look at our returns since inception, since 2008, we've had an average audited return, again, net of fees, close to 10%, just under 10% there.
And to be clear, Ches, that's actually a 7% annual return, but paid out monthly, right?
That's right. That's right.
Yeah.
Now, we are in the business of delivering one-year term mortgages. So we're not a long-term lender. When people think of mortgages, they think of their conventional bank that might offer them a 25 or a 30-year term mortgage. We are an interim solution to people. And so we offer these shorter-term mortgages at higher interest rates and turn the money on a very fast basis in terms of the fund. So we don't hold a mortgage in our books for 25 years or on a 5-year term, fixed or variable. We're in a different segment of the mortgage market that we'll talk a little bit through tonight. We really focus in the market of Western Canada, and we are strictly in the residential market, looking at the urban markets. We'll talk a little bit more as to why we do that as we go through today. The opportunity that we have is one that essentially is a void, you might say, left by Canada's big banks. And that void has been in place for the 40 plus years that MICs have been in existence. But I would say in the last handful of years, really over the last 5 to 7 years, that void is growing. And especially with some of the newest rules that came out even in the last year, the B20 rules that many people might have read about with some of the tougher lending practices by the big banks, it's becoming more challenging for Canadians to secure conventional financing. And so this opportunity is a growing one for us, even though it's been an opportunity that's been around for decades and has been a good one for those that operate well. For us, we've been doing this, like I said, for over 10 years. We've done over 1,000 mortgages. We've never missed a monthly distribution, so we've delivered 100% of those distributions to our shareholders, which count now north of 1,000. We're a private corporation, so like you talked about, non-correlated assets. I think what you're referring to is not correlated to the volatility of the stock market. We're a private corporation. People do become a shareholder, no different than a shareholder that they would become in a publicly traded corporation, but these are privately held shares. There's less liquidity. Those are discussions that we can have with people as they think about investing in a private corporation versus something on the public side. But what I do want to talk a little bit about is some of the lenders in the Canadian marketplace and what that looks like for people. Most of the time when people think about mortgages, they think, okay, the big banks, the RBCs, the BMOs, the TD banks, the Scotias. Those are the Schedule I banks in Canada. And they really are the lion's share of the residential mortgage lending market in the country. But in addition to them, there's trust companies And in the last decade, a growing number of what are called mortgage finance companies. So between the trust companies, you can think of companies like People's Trust out of Vancouver, Home Trust out of Ontario. In the mortgage finance company range, there's a bunch of names that if you've had a mortgage through a mortgage broker, you might get paired up with a company like First National, Merrick, Street Capital, MCAP, which is the first mortgage finance company back in the late 1990s. So those companies have had a growing space, but the three that are on your screen right now really probably make up 85% of the residential mortgage market in Canada, the lion's share of that $1.5 trillion residential mortgage market in Canada. On top of that, provincially, there's credit unions. So in British Columbia, that can be Van City, Gulf and Fraser, Prospera, and others. And then there's mortgage investment corporations, which is where we participate.
And Ches, before you jump in there, just one thing. To be clear, those first four that you put in there, that's going to be your fully discounted mortgages that the average consumer is going to be able to qualify for, correct?
Correct. And also those will be the ones that will offer the high ratio mortgages where people can put, 5-10% down, CMHC insured, and participate in that type of way. A mortgage investment
and that covers 85% of the market.
Yeah, I mean, I would say maybe even up to the 90% range or higher, because really the Mortgage Investment Corporation, which is a big chunk or a good volume of activity in Canada, is still probably less than 5%, probably closer to about 3% of mortgage activity. These are pools of funds like AP Capital. We are regulated by the terms of our offering memorandum versus by the OSFI regulator, which is federal, or the provincial regulator, which oversees the credit unions. And probably as a total in Canada, the mortgage investment corporations probably are 5 to 10 billion. So it's a large space, but in the grand scheme of things, a small participant in a very, very big industry. And then finally, there's syndicated mortgage entities or organizers, you might say, and then there's private lenders. And private lenders are one-off, where one party lends to another party and the personal name is on file. And whereas in a mortgage investment corporation, you're a shareholder of the corporation in a pool of funds advancing across many, many mortgages. So we'll get into that a little bit more. A lot of times, it's good to understand the interest rate environment in Canada and where do these various parties play and participate. So, when you think of interest rates in Canada, on the far left-hand side, you got the Bank of Canada setting an overnight rate. They can change it 8 times a year. They have changed it 5 times in the last 16 months. This is, of course, pretty big news every time they make a change. Usually we see Peter on television telling us about how it's impacting each of us. There was an announcement last week, went up another quarter point, is now 1.75%. On the far right hand of the spectrum, you have payday loans for those people that can't quite wait for their paycheck to clear. Exorbitant interest rates on that one. When you think back on the left-hand side there, prime is influenced by the Bank of Canada rate. So prime now is sitting at 3.95. So depending on whether you're talking to a mortgage broker or your bank about a conventional 25, 30-year mortgage, you might be in that 4 to 5% range, or a discounted variable. The goalposts are moving as the Bank of Canada and prime is moving. When you think about alternative lending, like AP Capital, we're sort of in those high single digits, low double digits. We're typically lending out money in the low 9% range for a 1-year term. So higher interest, but shorter term. We're an interim solution. You can think of us kind of like bridge financing for people that are in a situation and I'll talk more about that in a moment. But there were certainly not a long-term 25-year pay off your mortgage solution to people. And then, of course, everyone knows that credit cards, if you don't pay the balance, double digits up into the 20s. So, that kind of gives the picture, I guess, of interest rates in Canada. Now, the most important element in our business is the security of our capital and the security of our investors' funds. So when you look at the types of mortgages that we look at on a daily basis. Those are secured against real estate. So we like to talk about the things that we like, the things that we avoid, and the types of deals that we will not do. So we like single detached homes. We like homes that have a front and a backyard, that are in a neighborhood, that are in urban markets. So we don't care for the very rural areas of the provinces. We really don't care for the places where there's not a large population base of 75,000 or larger. So we like the 3.5 million people that live in the Lower Mainland. We like that whole Lower Mainland market where we're very active. We avoid the very unique and the very high-end properties. Now, that could be very unique and very high-end in West Van. That also could be very unique or very high-end in Chilliwack. And so those are the things that we avoid because they have a smaller market when the real estate turns and goes in a declining side. There's less buyers. There's less possibilities of that property selling at maybe what is thought to be its value. So we avoid that. We also avoid doing lending on construction or land. There's others that participate in that. We stay away from it. As far as will not, we do not lend to non-arm's length borrowers. That's a bit of a mouthful. Really, we find all of our borrowers through mortgage brokers. So they're people that we do not know. We like that because then we can be rigorous in our collections.
So you're not giving a loan to your brother-in-law because he's got this amazing development opportunity.
Exactly. That is a challenging proposition when things go sideways or when he can't make his payments. And so that's why we stay out of that development stuff as well.
Yeah. Ches, just to jump in here, one of the biggest questions we get, let's say somebody says, wow, I love this space. This is fantastic. Yeah, this is, and lending in mortgages, it seems safe and secure, et cetera, et cetera. So I like the concept of a MIC, a mortgage investment corporation, but I've heard there's lots of different MICs out there. Are all MICs created equal? And you mentioned what you like and what you avoid. Can you touch on the reason why, and maybe give us one example of why you would not do construction or raw land, and why you stick to, average house, average street, average neighborhood?
Well, today's market is a good example of why. We are in a declining market today. The value of homes across the Lower Mainland, across Canada, are probably worth less today than they were on this same day last year. You can just open the paper, but more importantly, look at the data. The data shows that, we're down year over year, single digits, some neighborhoods, double digits, year over year declines in prices. If you have a home that's under construction in a declining market, you're in a little bit different perspective on finishing that home and finding a buyer. If you're sitting on land, land is always desirable when the market's strong and increasing, but when the market's in a decline, that's when the opportunistic buyer is out there trying to buy the land for the cheapest. And so everything looks rosy when the market is up and to the right, pretty much like it's been since, let's call it 2010. But here we are 8 years later, and we're looking at a declining market that could decline for the next number of quarters. It could then be, flat for the next, long period of time. No one has the perfectly clear crystal ball. But we like the single detached home in the urban market because when it's not a premium priced home and it's in Langley, or if it's in Burnaby, or if it's in a community where families live, those tend to move less quickly on the downside. And they also move a little less quickly on the upside. So we feel like there's the best security on them. Also, many times when, in our world, we like to find owner occupied homes, because owners make their monthly payments. And if there's a mortgage against a rental or a mortgage against a construction project and things get challenging, people continue to make their home mortgage payment where their kids and where their family sleeps at night. So that's why we like what we like.
Another further to that, it's interesting. I know not to disparage anybody else, but there was another mortgage investment corporation that did business in Calgary, and their focus was on development and construction. And they lent to a lot of developers building high-rise towers in the middle of that before the oil crash. And the markets crashed in Calgary and Alberta because of oil. And congratulations, when they went to foreclose, they had to foreclose on a half-finished concrete high-rise tower. So I think one of the things you've kind of touched on, but may or may not be obvious to everybody, this secret or key, if you would agree with this, Ches, is your ability as a mortgage lender to be able to foreclose, get the money back, and liquidate that asset and get the money back in the fund to protect the investors. If you're doing that on a high-rise tower, it's pretty hard to foreclose a high-rise tower and sell that asset quickly.
No question. And I think, that speaks to, as I move into these next slides, I think it talks to that point as to how we underwrite and how our underwriters look at deals that flow in on a daily basis. We see, dozens every week. And what our underwriters first look at is the property. They look at an independent appraisal, and they can look at that appraisal to determine value, to see the home, to know the neighborhood, to look very closely at the comparables. The local knowledge is very important. We're very active in the Western provinces. We don't lend in Winnipeg. We don't lend in Halifax. We lend in the areas that we have local knowledge. And we also pay very close attention to the value of the home versus how much of a loan that person will put against that home. So loan to value is a key component. Secondly, and almost as important, is the borrower themselves. Are they somebody that's very high net worth, or are they very high or low income? Sometimes those things are at odds with one another. Somebody's high in net worth but very low personal income. Sometimes they have great credit, sometimes they have poor credit. Obviously, we like people with good credit, and we've seen an uptrend as it's more challenging to work with the banks. We're seeing a better quality borrower in 2018 than we did back in 2014-15. We also see a lot of business.
That's an interesting point you made there, because one of the things a lot of people are asking me, well, how's this impacting the mixed business with it being so difficult to get a mortgage these days? And you were talking offline about the fact you're seeing a change in the credit score.
No question. I mean, we monitor that data very closely, and we've definitely seen an uptick in the quality of borrower. The borrower that we see today is oftentimes, just a couple years ago, a bank customer that now is finding it more challenging to qualify with their bank. Many of them are business owners that are maybe showing professional or corporate income, but maybe not quite qualifying with their personal incomes, because the bank wants to see personal income. Show me your last 2 years of NOAs. And then, of course, there's always the borrowers that are in different types of financial situations. Unfortunately, some people go through divorce and they let their credit slide. There's illness that affects people. There can be job loss. And sometimes those little interruptions and blips in their life end up causing them to be, not a fit. And so we might be that interim bridge financing for them to then get back to the bank, and their mortgage broker helps them coach along the way to get there.
And just one more thing on that point. One of the most common questions I get from people when they think about investing in mortgages like this is, well, oh my goodness, if these people can't qualify at a bank, that must be very risky. So it scares some people away from investing into a MIC because they think surely this has to be a high risk.
I think it's just important that when people talk to a MIC or a mortgage company like ours, that they just ask lots of questions to understand what types of borrowers they're dealing with and what types of security that they find, because there's just two different there's many different elements to the mortgage flow that comes into a company like ours. I mean, you see all types of risk along the risk profile, from the mortgage that you're going to have challenges with, but the security is so strong, to ones that are going to be fine, but are pushing the other end of the spectrum. So not all, as you said earlier, not all MICs are created equal. Just kind of speaking to the portfolio, it's really important that the portfolio of the firm that you're looking at. So in our environment at AP Capital, we publish our portfolio's fast facts every single month. We deliver them to all shareholders in email. They're also posted to our website every single month. A few of them are on your screen now. So to end the month of September, we had 253 mortgages. 96% of them were in BC, 100% residential. About 85% of those were single detached homes. 67% of our funds are in first position, the balance being in second. And the average loan to value, we try to keep this under 70. We've made a very concerted effort over the last 2 years to keep it down into the low 60s. And that means that there's 40% equity. And as we see a declining real estate market like we're in right now, that loan to value of 60 can turn into 70 as values drop. So it's really important that you are mindful of these things. If I just flip two of those numbers around and I take 67% of my funds in first mortgages and I flip that to second mortgages, and if I take and maybe add 10 points to the loan to value and pump it up to 70, well, sure, my returns might be reflected, but I'm changing the risk profile of my fund dramatically. And, I think you've asked me this question before. Sometimes investors or potential investors ask you, well, I might know of a MIC that might pay a higher rate of return. With greater return comes, a risk that goes along with that. So I think it's just important that people understand all the elements of a business, and it's, constant ongoing reporting is very important for people to see so that they feel comfortable.
Absolutely. Yeah, absolutely. And by the way, I added the fast facts that you produce, the October 31st edition of that. I've dropped that as a file for everybody, so you can download that if you're on the webinar.
Excellent. This loan to value is such an important part of our business. I just want to show a quick image on this so that people understand. The image on your left shows the 60% loan to value scenario where somebody has $1 million home. They maybe want to put a $400,000 down payment, and we offer them a $600,000 first mortgage. That puts us at a 60% loan to value. On the right-hand side, maybe the person already owns their $1 million home. They have a $500,000 first mortgage with another institution, and then they wish to access some of that remaining equity, so they come to us for that $100,000 second. They might want to help their kids with a down payment. They might want to buy out a business partner or expand their business or fix their home and renovate it for a sale. There's many different scenarios why people add a second for purposes that enrich or improve their life. Sometimes they consolidate high interest debt that they maybe ran up over the course of an illness or a job loss, or an illness or job loss of a spouse or member of their family. So there's many different scenarios of why people need that second mortgage. But in either example, we're at a 60% loan to value. And it's very important for people to kind of understand that, just because it's a second doesn't make it inherently a, quote, bad mortgage or a higher risk. They price higher, but, I would rather have a 60% loan to value second than an 80% loan to value first from a risk perspective. So, I think, second mortgages are not always all bad, but they are just, a tool in the toolbox of a mortgage broker and a homeowner and a lender like us, and should be considered, in the whole picture of a mortgage portfolio.
Right. And what's a typical example of the maximum loan to value you would go to? That was one of the questions.
Yeah, so, that has changed. Obviously, as we've seen a declining market and rising real estate prices, we've continued to lower our threshold on what we'll look at from a maximum standpoint. Today, we don't lend above 70% loan to value on a great credit client on a home that we really, really feel strongly and feel good about. That, maybe 2 years ago, we would have gone to 75% loan to value on that. So we're always sort of adjusting based on how we feel the market is either, heating up or starting to cool down. And then, of course, the quality of the borrower, the quality of the asset, also have a very, very strong influence on how high we'll go. But today, we're not lending over 70%.
Yeah, it's a balancing act between getting a good solid return, maintaining that 7% target for the investors, while also protecting their capital with smart lending.
Yeah, no question. So when people think about investing in AP, we're just going to touch on a couple things in our final few slides. We have a minimum investment amount of $10,000. That might not be suitable for everybody, but talk to Peter about your personal situation. We accept all registered plans, RSPs and TFSAs. The monthly distribution, as we've talked about, it's not a guaranteed monthly distribution, but we've never missed it in our 10 years. It's currently at 7% per annum in cash or DRIP. And then when our audited return exceeds 7, And we're tracking that. We're not living in a vacuum all throughout the year. We're watching it week by week, month by month, quarter by quarter. And when we close the year and perform our audit with our auditing partner, we deliver that excess 13th return to the investors. To speak to audited returns, in 2017, audited returns were 7.03%. These are net of fees, so this was to the shareholders. That turned into about 7.25%. If you dripped, meaning reinvested your returns, you get the benefit of monthly compounding. Our 10-year average, as I talked about earlier, has been in the high nines. This year, as we're closing out 2018, we're going to beat 2017. It looks like. So we're feeling like we're on a good track. We're seeing that, as interest rates are rising in the conventional side, I sometimes say that when the bank gets a cold, we get a cough. And so we're seeing the influence of rising rates just overall. And it looks like, we're on track to be doing better than 2017. When you look at our performance historically, this is, I think, an impressive image for us to present to people. We're the black line. Those are audited returns reinvested year over year since 2010. The bright pink line is reinvested total returns of the TSX S&P. So, they have some good years, and then they have some years that pull them back, and they have some good years and some years that pull them back. So that's the total
for those
return.
of who, sorry, Ches, for those where we started out talking about volatility in the markets, there's an example of what we talk about, volatility versus lack of volatility.
And then the green line is just, to kind of show what a steady fixed income at 3% compounding looks like over the course. Now, July 1st, 2018, that was when we started the fund, even though we incorporated in 2007. And fair enough, the public markets took a beating in that next 12 months. So it wasn't chosen by design, except by the fact that we started around the time when the markets had a meltdown. But you can see what steady compounding does and the impacts of it. So again, the disclaimer says what it needs to, and that is past investment returns are no guarantee of future investment returns, but certainly, they help people understand where we've come from. When you look at us from a corporate standpoint, I'm in our Vancouver headquarters this evening, and I'm here every day with our mortgage team. This is where we do our origination, where we do our underwriting, where we manage all of our portfolio of mortgages. We do collection and enforcement from here. Our investor relations is here. Our treasury opens twice a month for new investors. We redeem shares for those that wish to cash out either a portion or all of their holdings. We do that once a month. We do distributions on the first of the month from here, and we do all of our third-party coordination with firms like with Peter Kinch and many others that we work with. Important for people to know that we run, with a corporate governance structure that we feel has us, as well established, with 2 independent advisory board members. These are not partners of the firm. They're not founding partners. They're not managing directors. They are both shareholders that have invested in the fund and have impressive resumes, as they're both in their retirement years now, and just are very much involved in the material risk analysis and oversight, even with our audit review committee and compensation committees. We also work with our professional partners, so our auditing is done by MNP, legal by Clark Wilson. We work with investment dealers and exempt market dealers for raising capital. Folks like Peter are instrumental to us in that regard, and our banking is done with HSBC. That's my last slide, so I'm assuming that there might be some questions, but our contact details are on the screen, and everyone knows how to contact Peter for more details as well. I might also add that we are going to be hosting a lunch and learn at our offices here in Vancouver next Wednesday. And I believe, Peter, you have a first come, first serve for that lunch and learn. And if we oversubscribe, then we'll have a second and a third one. But I'll let you speak to next Wednesday, and we'll open it up to questions.
Yeah, well, thanks, Jeff. That's awesome. And just from a logistics perspective, if you aren't already aware of it, there's a little box if you're on the GoToWebinar. You click on question, you can type in your question. Jeff, been interrupting you as we go here and answering the questions as we go, so we've pretty well answered everything. Real quickly, there's one more question here, but I'll get to that. The Lunch and Learn. We're going to have that right in your boardroom, so there's only seating for 8. So if you're interested in the Lunch and Learn, send me an email at peter@peterkinch.com, peter@peterkinch.com. Send that to me. We'll get you registered. If you want more information on anything you heard tonight, please phone me directly. 2 things in closing here. One question. Are the distributions taxable within a registered account, such as the RSP and TFSA? I can answer that. Yes. This is completely TFSA and RRSP eligible. Just one last thing.
I wanted to add, because maybe that question is asking a different one, and that according to the question, are the distributions taxable in those registered accounts? And the answer to that would be no, they're not taxable if they're held inside that registered account. I'm not going to get into the details there, but wanted to make sure that we understood that one.
Chris said yes, thanks. Good job catching that one, Ches. Okay. Any other questions from anybody there? If you just type that in right now. Otherwise, we'll wrap up with one last question I have for you. Obviously, I think we have to touch on the fact that this is not a guaranteed investment. There are risks. What would you say is your Armageddon worst-case scenario? So let's say somebody wanted to be super negative and say, well, what if the Vancouver housing market completely collapsed? What would your answer be to that?
Well, I believe that investors in the real estate market and in the mortgage market need to have some inherent belief in real estate. So, if somebody truly believes that their home is worth half as much as it actually sells for today, then I think that they should probably look into different asset classes than real estate or mortgages. So, I think that's a fair comment to say. I do personally think that Vancouver real estate is premium priced. It always has been. I think that we're seeing a softening today, but I don't personally believe that the home that I own and live in is worth half as much as what it would sell for today. So I feel confident in being an investor in the real estate space and the mortgage space that's backed by real estate. So I think that's how I would answer it, is that the belief in just general real estate, yes, it will rise in value, it will decline in value. But if people truly believe that there's just some enormous overvaluation that's in place right now, then they probably shouldn't invest in real estate, period.
That's a great point. And on that note, one last thing is you have your current loan to value on your overall portfolio is what, 62%? I know we sent that out in the APE Fast Facts, but the overall portfolio is what?
Yeah, it actually closed out October at about 58%.
So the market would theoretically have to correct by 40% before you guys are offside.
That is correct.
And your mortgage terms are only 1 year. So a year from now, let's say the real estate market in Vancouver corrected by at a 40% correction, which, by the way, if that happened, we've got bigger problems. But if that were to happen, then that wouldn't happen overnight, would it? It would probably take a year.
That is correct. And when we're doing mortgages in the month of November, we're doing them based on appraised values in November. And the independent appraisers that we use are very mindful of a declining market. So they're not propping up numbers to a lender on an appraisal today. They're being very mindful of the fact that houses are worth less, a little bit less every day, a little bit less every week or month. And so we're underwriting deals today based on a declining market, and even our team is very mindful of that. So when we see a number, we're always looking for that lowest loan-to-value deal. In fact, if you look at the deals that we did in October, we funded about $5 million in mortgages in the month of October, and we did them at under 50% loan-to-value. So we are looking and sourcing the most, kind of conservative loan-to-value deals right now. Is it because we believe that the market's going to drop by 50%? No, we don't believe that. But we're just being as prudent as we can and finding those best, equity-filled opportunities that are out there. Because, we'll see what happens. I think that a lot of the telling is going to happen as we move into that spring selling season next March, April.
Oh, absolutely. It's going to be interesting. Well, Ches, listen, we're going to wrap it up here, keep this tight on our timeline. And first of all, I just want to thank you very much for sharing with everyone tonight. And I can just say, from my personal experience, if anybody's ever talked to me, I am extremely bullish on this type of investment because for multiple reasons. First of all, I understand the mortgage business inside and out, and I understand that not all MICs are created equal. I can tell you, I know Ches and his team personally. I can vouch for these people, their character, their integrity, and the way they do business is phenomenal, and that's why I'm such a huge fan of AP Capital. Not all MICs are created equal, and it's important to understand that, and it benefits us to learn the difference of why one can be better than the other or make more sense. It's an investment asset class that I think is underrated and underutilized by most investors. We're not suggesting you put all your money in there, but it's well worth looking at taking a portion of your investable assets and say, maybe I'm going to take some of my money out of mutual funds or the stocks and bonds and reallocate a portion of that into a non-correlating asset that is backed by real estate. And if that makes sense to you, either A, give me a call, send me an email, touch base, and we can follow up. Or if you live in Vancouver, we're going to have Lunch and Learn next Wednesday, a week today, November 14th from 12:30 to 1:30. Thank you in advance, Ches, for providing sandwiches. And other than that, ladies and gentlemen, I hope you have a great night, and we look forward to following up again. Ches, thank you very much, and we'll talk to you soon.
Thank you, Peter.
Okay, folks, that's it for tonight's webinar. Thank you very much. Bye for now.